Before we start talking about fixed interest rate mortgages, let's talk about the determinants of mortgage interest rates, and specifically real versus nominal interest rates. The real rate of interest is the minimum rate of interest that must be earned by savers to induce them to divert the use of resources, their funds, from present consumption to future consumption. The nominal interest rate is the contract interest rate that's agreed upon by borrowers and lenders. So, what about the risks associated with interest rates? Well, first, there's default risk, and that's the risk that borrowers will default on obligations to repay interest and principal. Interest rate risk is the uncertainty about what interest rate to charge when a loan is made. Prepayment risk is the risk that the loan will be prepaid when interest rates fall below the loan contract rate. So interest rates fall, borrowers refinance to get a lower interest rate, but that's bad for the lenders who were anticipating those cash flows. So that prepayment risk is a risk to the lender. And then some other risks include liquidity risk and legislative risk. Liquidity risk is because securities that can be easily sold and resold in well-established markets will require lower premiums than those that are more difficult to sell. Legislative risk refers to changes in the regulatory environment in which markets operate. So to summarize then, interest rates are equal to the real rate of interest plus a premium for the various risks associated with that particular nominal rate of interest, plus anticipated inflation. So now what about these fixed interest rate mortgages? Well, first, there's a loan amount, and that is the amount that's borrowed and what the borrower is legally required to repay. The loan maturity date is the date by which the loan must be fully repaid. The interest rate is the nominal annual rate of interest, and periodic payments are those regular cash flows from the borrower to the lender according to the amortization schedule.